Good afternoon, everybody. Thank you very much for joining us today for our next dental webinar. Today's topic, we're going to talk about year-end tax planning in this COVID-19 environment and the impact the presidential election had on tax planning and taxes in general. We've got a lot to talk about. We're really excited to have you join us today. Again, we're going to cover the tax impact that the election had, touch a little bit on PPP loans and where those are, talk a little bit about the HHS stimulus payments that came out and what you might have to look forward to with those. Then get into some business and individual tax planning tips here before the end of the year. And we're gonna do that all in 30 minutes. So we're gonna fly through a bunch of stuff. As you have questions, as you think of things, please use the chat function here to send those to us. We will hopefully have a little bit of time at the end to do some questions, or if some really important ones come up during the presentation, we might interrupt things and cover those then. My name is Matt Vanderloo. I'm a principal at SVA. I work in our healthcare group with lots of dentists and dental specialists, and I am joined today by Laura Zock, another principal in our healthcare group. And actually, I'm going to kick things right over to Laura and let her jump right in and talk about the election we had this fall and how that might change the tax world a little bit.
Great. Thank you, Matt, for the introduction, and thanks to you all for joining us. We've got a lot to get through, so I'm going to jump right into our content. It's that time of the year where year-end planning is very much in full swing, and one thing that's top of people's minds this year is what might some potential impacts be on tax law with this election that we just had. And the current unknown right now that's adding some uncertainty to this is what's going on in the Senate and what will the makeup of that Senate be. There are two seats in with the Georgia seats that are currently in a runoff election that is set to happen on January 5th, so just a little under a month from now. And the Democrats would need to win both of those runoff seats in order to have a 50-50 Democrat-Republican split in the Senate. So the turnout of that election really is going to be key to help figure out, will we see some changes in tax law with a Biden presidency, and ultimately affect the timing of when we might see things as well, depending on what kind of compromises we can come to with all of that. So what I wanted to talk through today are what I would consider to be 10 of the most potential tax law changes that we might see under President Biden. First, there's a couple that we might see having to do with business or corporate taxes, and that would be an increase in the corporate tax rate. It's currently 21%. More recently, a few years ago, it had been 35% before 2018. And Biden's tax plan would be to meet almost somewhere in the middle on that. That 21% rate would change to 28% for corporate taxes. Now, that only affects you if your business is set up as a corporation. And many dental practices are set up either as partnerships or as corporations or even sole proprietorships. So that particular potential tax law change would not affect those business folks. Another thing we might see that would be set up to help encourage and facilitate small businesses setting up retirement plans would be enabling some tax credits for those small businesses to help pay for the setup of those retirement plans. One corporate or business tax change that we might see that would affect non-corporations, so S corporations, partnerships, LLCs, sole proprietorships, would be a potential limitation on the 20% qualified business income deduction. This is a deduction available to those that have pass-through entities. So as I said, SCorp partnership, sole proprietors, and what we might see with a Biden presidency is that deduction would be limited or phased out for those with incomes greater than $400,000. So that's something that could most certainly affect those of us on this webinar today. Another change we would see with businesses might be Social Security taxes. Right now, Social Security tax is a 6.2% tax that both the employer and the employee pay on wages up to about $137,000 for 2020. And under Biden, we might see an expansion of that, where those Social Security taxes would kick in again at wages earned over $400,000. So here's a situation that we call a donut hole concept, where in the middle of those income ranges, we don't have Social Security taxes apply, but we would have it charged on wages before the 137,000 using 2020 numbers, and then above 400,000. So that's a tax law change, a potential tax law change that would affect both individuals' net cash flow, but also businesses' tax expenses. Moving on to talk about what some individuals might see. We might see that the top tax rate would be restored from the current 37% that it is now to the old top tax rate before Trump's tax cuts, which was 39.6%. Currently, that top tax rate is set to restore back to the 39.6% at the end of 2025. But depending on what Biden is able to achieve regarding tax changes, we might see that top tax rate back in place either in 2021 or possibly in 2022. And that would apply for higher income taxpayers. And most of Biden's potential tax changes, when we talk about higher income taxpayers, for him, that threshold is incomes of $400,000 and higher. That same group of people would also see some changes in itemized deductions. Right now, there are not caps on itemized deductions outside of the deduction that you can take for state and real estate taxes. Under Biden, we might see that the tax benefit of itemized deductions would be capped at 28% for those in those higher income rates. Also, the PEAS limitation might be restored, and that was something that essentially took a haircut for higher taxpayers with large itemized deductions, limiting their itemized deductions as well. One benefit we might see, though, in the area of itemized deductions is that Biden supports the idea of removing that $10,000 SALT limit, the limitation on taxes that we pay to state, local, and real estate taxes. And that might end up actually helping some taxpayers who have large individual tax bills. People with incomes over $1 million might see an increase in their capital gains rates. Right now, capital gains are taxed at preferential rates, either 0, 15, or 20%. Simply speaking, depending on your income amount for the year. Those with over $1 million of income under Biden might see capital gains rates taxed at ordinary rates, or the marginal rates, which right now, our higher tax rates are 32%, 35%, 37%. Under Biden, that tax rate, as I mentioned earlier, might be moved up to 39.6%. Another thing we might see would be temporary increases to child tax credits and dependent care credits. So really some tax deductions that support families and people with children or people caring for relatives. We might see that child tax credit increase to either $3,000 or $3,600 per child, depending on their age. Income phase outs would still likely apply as they do now. And then the child tax care credit, we might see be more like $8,000 for one child or $16,000 for two or more. And that is a credit that's meant to help cover some of the cost of daycare or camps, because as those of us with kids know, those costs are not cheap for sure. Biden might also implement a family caregiving credit up to $5,000. So imagine here receiving a credit for perhaps caring for someone elderly in your family. Aside from the potential business and corporate tax changes we might see, also what's received a lot of press are potential changes to estate and gift taxation items. Currently, the top estate tax rate is 40%. We could potentially see that move to 45%. And also affecting a lot of higher net income or higher net worth folks would be a change in the reduction or a change in the amount of the lifetime exemption. Currently, these exemptions are at $11.6 million, double that for when you have a spouse. Those would roll back to some quite old amounts of $3.5 million. So here's where estate planning should be a priority for those of you that are higher net worth families, and making sure that you're doing the things that you can in order to maximize your wealth transfer to your family. So really, with all of these potential changes, what we're facing right now is just a lot of uncertainty in every aspect of not just our lives with COVID, but also our financial lives and tax lives too. Estate planning should be a priority with these potential increases in tax rates that we might see. When you're thinking about year-end planning, normally we talk about deferring income. This might be one of those situations where deferring income might actually be more costly if we implement that this year. So something to keep in mind as you work through your year-end tax planning process. Another area where we see a lot of uncertainty right now as well, nothing new there, is on the PPP topic, which ever since that was rolled out, it's always had a lot of uncertainty, right? So let's move on to that topic. Now, the current rules regarding PPP loan forgiveness, which should be the state that we are all at, is trying to figure out and work on that PPP loan forgiveness paperwork, if we haven't already, is right now there's no change on the rules around us here that we've known since probably about May. Currently, the income from forgiven PPP loans is not taxable. That's a good thing. But on the flip side, the IRS has ruled that expenses that are used for PPP loan forgiveness are not tax deductible. So here, essentially, that makes the PPP taxable. Now, for a number of months, there's been different legislations, different stimulus acts have been proposed that have included a change to that, where these forgiven expenses would be considered tax deductible. But still, on December 9th here, we don't have any final answer on that. There is another bill that was presented this week that some folks are thinking we might hear by Friday or perhaps early next week on, where maybe that rule will change, and that would be a great thing for all of us moving into year-end planning season. One of the biggest questions we've been getting around PPP is, when should I apply for forgiveness? And as we move on and talk about this, the big consideration here was, do I want it forgiven in 2020? Do I want it forgiven in 2021? Is there one that's better for me or not? The IRS has recently put out some guidance on this, where when you apply no longer matters. What they've come out and said is that if you have reasonable expectation that you will have forgiveness of your PPP loan, then you can't expense you can't deduct those expenses on your 2020 tax return. So what it's gotten us to is a position where it doesn't matter when you apply, it doesn't matter if you've applied, as long as you think with reasonableness that those expenses are going to be forgiven, which for most practices, you had a lot of payroll expenses, right? You continue to pay your rent in most scenarios, et cetera. It's expected that your PPP loans are going to be forgiven. It's not going to matter. Right now, the ruling is that regardless of that, you cannot deduct those expenses on your 2020 income tax return. So as I mentioned before, there's still some hope and speculation that that rule might change, but that's one of those things that we're anxiously awaiting getting, hopefully, some final answers on, so that we can get everyone in a good position on taxes this year. So what does this all mean with year-end fast approaching? The theme remains to be uncertainty. When you look at your PPP tax planning, what we're doing is looking at what you might see. And right now, with the uncertainty around whether or not those forgiven expenses will be deductible, it's a potential big swing in taxes if they are and if they aren't. And at this point, it's important, with the year-end closing out in a couple of weeks, to know what's your tax liability going to look like if those expenses remain to be non-deductible, and what your tax liability might look like if the rule changes and those expenses do become deductible. Here's where, depending on how your dental business is set up for tax purposes, the planning, the strategies, the considerations are going to differ, depending on if you're a C corporation where there's a corporate entity level tax, or an S corporation or a partnership or a sole proprietorship where essentially the income is all passed through to you as the owner. So it's really important to be sure you're connecting and having conversations with your tax advisor around what might it look like for you, what decisions need to be made to put yourself in the best position to save taxes and maximize benefits going forward. Now moving on a little bit, changing focus for a couple slides here. Another important item that came out of all of this COVID-19 was HHS provider relief payments. You'll recall that as dentists, we were able to apply for phase 2 and phase 3 of provider relief payment applications for funding from HHS. And what I wanted to make sure you all were aware of is that anyone who's received more than $10,000 across any phase of provider relief payments, that there's going to be some reporting required starting early after the year refreshes. The reporting is all going to be done through an online portal. That portal should be open and start to accept the reporting as early as January 15th, 2021. And the first deadline is a month later for initial reports, February 15th, 2021. And that is your only deadline right now if you have utilized all of your HHS funds in 2020. If you are going to need some of 2021 to utilize those provider relief funds, then there's another report that's going to be due by July 31st to show the folks at HHS how you spent those funds. Talk about guidelines for use of those PRF funds. It's important to document and maintain that what you're using the PRF funds for were not also reimbursed from other sources. So for example, the PPP loan. The guidance is that your PRF funds should be used for healthcare related expenses that are attributable to coronavirus. There's many more specifics on the hhs.gov website about what that might include, but think about this as the supplies you needed, the equipment you purchased, perhaps an upgrade in information technology, if you hired an additional employee really to help you manage and be able to continue your business through coronavirus times. After you've considered those expenses, the remainder of the PRF funds can be used to help substantiate the difference of your actual 2020 revenues versus what you saw for patient care revenues in 2019. The reports are going to require information like what's the tax ID number for your organization, what's the tax setup, are you an SCorp partnership, etc. You're going to need to provide some information about your lost revenues and to substantiate your expenses that are attributable to COVID-19, whether or not you received other assistance in 2020. So think of that as PPP funds, maybe state and local grants. It might be the Delta Dental provider one-time payment too, and then some other non-financial information about your employees. So Matt and I just wanted to make sure we covered this a little bit in this webinar today, knowing that it's related to COVID-19. This is one of those things where maybe it was an afterthought to folks and maybe not known right up at the front when we were all working on getting our phase 2 and phase 3 applications in for these HHS funds. There was a couple other items regarding taxes that are really specific to COVID-19 that are in play for this year as well. The first one being the employee retention tax credit. I'm not even really going to talk about that one. There's a little information on your slide here, but this only applies if you did not have a PPP loan, and most of us had PPP loans. There was a refundable payroll tax credit that was to help businesses provide for extra sick leave and family leave to help people with COVID-19 under the Families First Coronavirus Response Act. And then also there is a special rule this year where a qualified individual, by definition of the IRS, could take out IRA distributions of up to $100,000 without that 10% early withdrawal penalty if they were financially affected by coronavirus or had coronavirus. And that tax can be either paid all in this year if your income is low and it makes sense, or it could be paid over 3 years. Now, hopefully you still have some space left in your head. We still have some time left here because Matt is going to share some business tax planning tips for us all in your dental practices.
Yeah, let's jump right into some business tax planning ideas that aren't really specific to COVID, but are going to be some great ideas to think about and apply any year, anytime, no matter what's going on. The first one here, make sure you're reviewing your retirement plan design. Just because you have a retirement plan set up, you might have a 401k plan set up, doesn't mean that it's set up, its specifics are exactly what you want to accomplish in your practice. And there might be ways to play with that design a little bit and make some tweaks to get an even bigger contribution in, or to get more of the contribution to go to you. So remember, 401k profit sharing plan, your total maximum contribution between your deferrals and the profit sharing is $57,000 for 2020. That jumps up to $63,500 if you're over age 50. So that's our target if we can. We'd like to get that much put away for you. And then in really well-designed plans, we see that we can get up to 60% of that profit sharing contribution to go to the owner or owners and the 40% to the employees. So if you're not getting there with your plan, there might be an opportunity to take a look at its design and leverage yourself into a little bit better position. And if you're able to maximize what's going into that 401k plan and you still want to put away more retirement plan dollars, there are other plans that we can add into your business, into your practice on top of that. The most common one is a cash balance plan. And that can be a way for owners to potentially put away another $50,000 to even $100,000 of retirement plan contribution. So we can really get a lot put away, but it really depends on the plans that are in place and how well designed they are. Second big idea here is make sure you're reimbursing yourself and all the owners in the practice for any professional business expenses that might have been paid personally. So if you're paying any dues, any continuing education expenses personally, make sure the practice writes you a check for those by the end of the year. So the practice can deduct those and you can pay for those pre-tax. And those typically are pretty common ones. The ones that sometimes get missed are your cell phone. You're probably using your cell phone for work. Make sure work is paying for at least some of your cell phone. The internet at home, lots of people are on the internet at home looking at patient records, charts, looking at the schedule. Deduct some of that home internet expense or reimburse yourself for some of that from the business. The Section 179 deduction, bonus depreciation are still really powerful tools. If you've had any equipment purchases here in 2020, we can leverage you into a higher deduction with both of those. Remember, with the 179 deduction, we can potentially expense more than $1 million of fixed asset purchases. So you can buy a lot of equipment in 2020 and get a deduction in 2020 for those. And a really powerful thing to think about is there equipment that you think you're going to need to replace or that you want to purchase that you were planning on early 2021? And do we want to then move those, purchase those right now in December and get the deduction right now in 2020? So if we buy it just a couple months earlier, we can get it on a tax return a whole year earlier and get that deduction right now. As we're getting close to the end of the year, you want to look at your supplies, your inventory of dental supplies and office supplies at your practice. Is it time to restock now? Get those in the office right now so we can get a deduction on this tax return instead of the next tax return. If you have a high deductible health plan, make sure you're maximizing your health savings account contribution. So for a single taxpayer on single coverage, that's $3,550. If it's a family plan, it's $7,100. We want to get those put away on a pre-tax basis and get that deduction on your return. And remember, the great thing with the health savings accounts is that those dollars don't have to get spent in the tax year you put them in, unlike the flexible spending dollars. So those health savings dollars can sit out there, grow tax deferred, and as long as you're using them at some point for health expenses, they're going to be tax-free when they come out. If you don't have a high deductible health plan, now might be the time to think about that. It probably is a little bit too late to get it in place for 2021. But when you're renewing in 2021 for 2022, you might want to look at that as an option that make the HSA contribution available to you. And it might be a way to lower the health insurance premiums for the practice a little bit too and create some expense savings there. And then the other thing you want to think about is there a way to manage your year-end taxable income using all those strategies that we've just talked about to drive down your taxable income low enough that we might be able to take advantage of that Section 199A deduction or the qualified business income deduction. Same thing, just two different names. And remember that this deduction is really just it's a simple math deduction. We take a look at the taxable income from the practice, multiply it by 20%, and we get that as a deduction on your corporate tax return. So it helps lower that corporate tax and how much tax you're going to be paying individually. But the key here is that depending on your taxable income, you might get that full 20% deduction, you might get phased out of that deduction partially, or you might get it eliminated completely. So if a married couple filing a joint return, if your taxable income is more than $420,000, you don't get any of this Section 199A deduction. So if you're close to that $420,000 cutoff, can we use some more Section 179 deduction? Can we get some more supplies purchased before the end of the year to try and get your taxable income under that threshold so that you can take advantage of this 199A deduction? So as we're talking about that, the thing to remember is that you need to be an S corporation or a partnership to take advantage of that. So now is the time to think about, if you're still a C corporation, if you think you want to be able to take advantage of those, you've got a limited window of time here into early 2021 where you can make that election to become an S corporation for the 2021 tax year. Now, in addition to the 199A deduction, there's also the potential to save yourself some payroll taxes as an S corporation, because any profit you take out of the S corporation as S corp profit and a distribution, you don't have to pay any payroll taxes on. Typically, as a C corporation, you're taking all the profit out as wages to avoid the double taxation. So there's some potential payroll tax savings there. We also, as an S corporation, lower your IRS audit risk a little bit. We can make sure that we're paying you a reasonable compensation out of the practice, not paying all of the practice profit out as payroll, and get you some money out as a distribution for other people that might be generating some profit in the practice for you. And then we also open up the potential to take some Section 199A deductions, or those QBID deductions. So there's a lot of power in tax savings from making that election to flip over to S corporation status instead of the C corporation that you might be right now. You also might want to think about employing your spouse or your children in the practice. And this isn't just putting them on the payroll to give them a paycheck, but if they're actually performing services for the practice, then we can start paying them a reasonable salary for whatever they're doing for the practice. And the benefit here isn't really just in paying your spouse and in paying your children. It's really, once we start paying them, now can we start doing retirement plan contributions for them? So if your spouse is working for the practice, can we get the spouse eligible to participate in the retirement plan contribution and put away whatever they're making in wages into the 401k plan to get you that tax savings? Or if you put the kids to work in the practice, instead of just having them take those dollars and save them in a bank account, let's make a Roth IRA contribution for whatever earned income they have and put those dollars away so that those dollars can go tax-free for the rest of your children's life, which is going to be a nice long runway. So they're going to have a lot of time for tax-free growth on those dollars. Again, a great idea if your spouse, if your kids are actually working in the practice. We don't want to just pay them to not do anything. That's going to cause problems with the IRS. And we have to pay them a reasonable salary for what they are doing in your practice. A few other things to remember here at year end. This isn't really a tax savings idea, but just from a record keeping standpoint, remember you're going to need to separate those 100% deductible travel and meals expenses from your 50% deductible meals expenses, and separate those then again from your non-deductible entertainment expense. It's good to get that all sorted out right now. So as you're doing that year-end tax planning, you don't have any surprises because you tried to deduct during the tax planning process some entertainment expenses that aren't going to be deductible on that return. Another powerful deduction we've got for all the Wisconsin taxpayers out there is your practice can make an election to pay all the Wisconsin tax due on the practice income on the practice's tax return. So this is available to S corporations, partnerships, where typically that practice income would flow out to your individual return. We can make an election to tax that on the corporate return and save you money on your federal tax return by doing that. So that's a really powerful one to look into before the end of the year. And then if you're using your home or your vacation home for anything for the practice, if you have a employee holiday party there, if you have an in-person staff meeting, so maybe this year isn't the year you're doing much of that, but in the future, remember that that rental income, if the practice rents your home from you for less than 15 days during the year, that income is not taxable, but the practice still gets to deduct the rental expense. So you get a tax deduction in the practice without having to pick up income anywhere else, which is pretty nice. And then most years we'd really think about, let's defer income into the next year and let's accelerate expenses into this year. Laura already gave you some really powerful information on why this year might be a little bit different. This might not be the year we want to defer income into 2021 because we might see higher tax rates in 2021. We might not want to accelerate too many expenses from 2021 into 2020 because we're expecting higher tax rates next year, and those deductions might be more valuable this year. So there might be some specific reasons you want to, if you're close to that 199A limit, you might want to accelerate some expenses to make sure you get under it and can take advantage of it. But there might be some reasons to leave some expenses in next year and look forward to those tax savings at a higher tax rate next year. So those are the business ideas. Laura's got a couple individual tax ideas.
It would help if I unmuted myself. Thanks, Matt. First, I want to point out it's a minute after 1. We've got a couple more ideas we want to share, but if you need to hop off and go see your patients, please know this webinar is being recorded. It will be shared afterwards, and they're available on our website too. So you can catch up on the couple minutes of content we had left. Apparently, Matt, we didn't quite talk fast enough through this. A couple ideas to consider at year-end time for individual tax planning to help lower your tax bill would be to consider donating, if you have charitable intent, appreciated stocks. When you donate appreciated stocks to qualified charities, you get a tax deduction for the fair market value that that stock has appreciated to, not what you paid for it in the first place. And the appreciation, or the difference between the two, doesn't become taxable to you when you donate that stock. So that's a great strategy where you can do one thing and have like a two-for type of tax benefit for it. I'm just going to hit on a couple of the highlights here, not every single one of these, but another idea, Matt talked about the concept of employing your spouse in your business if you can, and the potential retirement plan benefits that might result in. If your spouse is not employed in your dental practice, but they have a side business or some income of some sort, not through another employer, consider setting up a retirement plan for the spouse's business so that you can capture some pre-tax retirement plan deductions there as well. There's a bunch of different opportunities available. Some of them need to be set up before year end. Some of them you have the flexibility to fund after year end before your tax return is due. So this is something good to talk with your tax advisor about as you work on year end planning. Another great idea is to consider using EdVest or whatever state you're in, their education or 529 plan, to help save for your children or other close family members' education expenses. Most states offer state tax deductions on a certain amount of contributions to these plans, and then the contributions grow tax-free as long as you use them for qualified education expenses. So this is a way to start saving early and hopefully get the most out of your money and save some taxes to help deal with the rising costs of college education for our kids. And now you can also use these plans to help pay for up to $10,000 of private school tuition for those college years as well. Also, a special planning consideration that might make sense this year would be to consider Roth IRA conversions. It was a challenging year for many businesses, and particularly dental businesses. Many of you might be seeing or are seeing lower incomes this year than you have in a long time. And with years of lower income like this, it might be the time to look at your IRAs that you maybe already have and consider converting those to Roth. The benefit here is that once they're converted to Roth, they grow tax-free and can either be used later in your life to pull from tax-free or pass along to your children for them to use tax-free. The caveat of this is when you convert that amount to Roth, if you don't have any basis in it, you pay tax on the growth. So it is something that is taxable this year, but as I mentioned, you might be in a lower tax bracket this year than you normally are, which is why this is a good planning point to consider for some of you this year. And then next, something else to consider, not necessarily directly related to taxes though, is around interest rates and your debt. Interest rates have been low for a while now. They have been really, really low more recently too, with everything that's going on in the economy and as the Feds try to stimulate growth and keeping things going. Please take a moment to review the interest rates on your debt, whether it be a practice acquisition loan or an equipment purchase, or maybe your real estate, your building loan. Think of this flowing over into your personal too. Maybe it's your credit card rates or perhaps your home mortgage, but check on your interest rates and see if you can do better on them to the point where it makes sense to refinance and ultimately save yourself some money on interest and perhaps the principal over time too, if you reset the amortization on those. All right, that wraps up our official content for this presentation. I'm gonna share the mic back with Matt, who's going to check in and see if we do have any Q&As that we can quick address here before we all get back to our days.
Yeah, so just remember, if you do have questions, please use the chat box down at the bottom of your screen to send those to us. And we do have one really good question here. I didn't commit to one piece of advice here, so somebody wants to put me on the spot and ask me if we'd recommend that they push income to 2020. And I think my first answer would be that it's going to be a very individual, a very practice-specific decision. I don't think there's good general advice here, especially because 2020 has been such a strange year. Practices were shut down for up to 6 weeks or more. There's lots of different stimulus, PPP loan, idle loans, things floating out there that might really make your financial statements look a lot different compared to previous years. So I think it's really important that every practice sit down here in December and take a look at where you stand relative to last year, where you stand relative to some of these cutoffs for the 199A deduction, and see what should we do in our practice to put us in the best position to go forward with this year. Some practices might benefit by pulling income, by not pushing any income to 2021, but by leaving it in 2020. If, for example, you didn't get a big PPP loan, yours was a little bit smaller, if you kept all your staff on board, if you had a lot of expenses for PPE, you might actually be in a position where you've got more expenses than income for the year, so you're showing a little bit of a loss. Let's pull whatever income we can into 2020 and at least get to a break even where we don't have to pay any tax this year, but we can move some potentially taxable income out of next year and get it sheltered by deductions this year. There might be other practices where they laid off the staff, maybe they didn't have as much in expenses, maybe they were a little bit better stocked on PPE. So we've got lots of income this year. We've got lots of taxable income, and we're getting really close to that magical number where we'll start to lose that 199A deduction. For that practice, it's going to make a lot of sense to try and push income into 2021, make sure they stay under that threshold so they can get the full benefit of that 199A deduction. So you really need to look at your specific situation, see what's going on in your practice, and then think about, should we pull income in, push income out, what should we do with deductions, and see where things land. I don't see any other questions coming through. So I just do want to take a second, remind everybody, we've got another dental specific presentation webinar coming up in January. Really going to focus on health insurance and health insurance in your practice for you and your employees. What are some myths? What are some facts? What do you need to know to really set yourself up well for 2021? You can go to the SVA Accountants website to register for that event. Hopefully we'll get a chance to see you all virtually then in January. Thanks again for joining us today. We really appreciate it. If you're an SVA client, please reach out if you've got questions, if you want to talk about year end. If you're an SVA prospect, please reach out. We'd love to meet with you, sit down, see how we can be of help. Thanks for joining us today. We'll talk to you in January.
All right, thanks, Matt. Happy holidays, everyone.